Warren Buffett, one of the most successful investors of all time, has built a fortune through a combination of shrewd decision-making, patience, and a deep understanding of business fundamentals. His investment philosophy is rooted in simplicity and discipline, and he has shared many insights over the years that can guide both novice and experienced investors. Here are 7 essential rules from Warren Buffett that can help you build and maintain wealth. 1. Invest in what you understand. Buffett emphasizes the importance of investing in businesses you understand. He advises against getting involved in industries or companies that are beyond your comprehension. By focusing on industries you are familiar with, you can make more informed decisions and better assess the potential risks and rewards. Buffett's investment in companies like Coca-Cola and American Express is a testament to this rule. He chose these businesses because he understood their models and could see their long-term potential. Following this rule allows you to avoid speculation and invest with confidence. 2. Think long-term. Buffett is a firm believer in long-term investing. He often says that his favorite holding period is forever. Instead of trying to make quick profits, he advocates for buying quality companies and holding onto them as they grow over time. This approach not only minimizes transaction costs but also allows you to benefit from the power of compounding. Investing with a long-term perspective requires patience and the ability to ignore short-term market fluctuations. Buffett's success with Berkshire Hathaway is a perfect example of how long-term thinking can lead to substantial wealth accumulation. 3. Focus on quality, not quantity. Buffett's investment strategy is centered around the idea of quality over quantity. He prefers to invest in a small number of high-quality companies rather than diversifying across many mediocre ones. His rationale is that it's better to own a few outstanding businesses than a lot of average ones. By concentrating your investments on businesses with strong fundamentals, competitive advantages, and capable management, you can increase your chances of achieving superior returns. Quality businesses tend to perform well over the long term, making them a safer bet for wealth building. 4. Buy at a fair price. One of Buffett's most famous quotes is, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." He advocates for buying great companies when they are fairly valued rather than seeking out bargains in lesser-known or struggling companies. Valuation is a key aspect of Buffett's investment process. He looks for opportunities where the market undervalues a quality business, allowing him to buy at a price that offers a margin of safety. This disciplined approach to buying ensures that he doesn't overpay and leaves room for upside potential. 5. Avoid debt. Buffett is famously averse to debt, both personally and in his investments. He believes that borrowing money to invest is a risky strategy that can lead to financial ruin, especially if the market turns against you. Instead, he advocates for living within your means and investing with your own capital. Buffett's approach to debt is evident in his management of Berkshire Hathaway, which carries minimal debt compared to its assets. By avoiding leverage, Buffett has been able to weather financial storms and maintain stability in his portfolio. 6. Stay disciplined and rational. Buffett's success is partly due to his ability to stay disciplined and rational, even in the face of market euphoria or panic. He avoids getting swept up in the emotions of the market and sticks to his investment principles. This discipline allows him to make sound decisions based on logic rather than sentiment. Buffett's famous quote, "Be fearful when others are greedy and greedy when others are fearful," encapsulates his contrarian approach. By maintaining discipline, you can avoid common investment pitfalls and make decisions that align with your long-term goals. 7. Keep learning. Finally, Buffett is a lifelong learner who spends a significant amount of his time reading and studying businesses. He believes that continuous learning is essential for staying ahead in the investment world. By constantly expanding your knowledge, you can improve your investment decisions and adapt to changing market conditions. Buffett's voracious reading habit is well documented, and he credits much of his success to his commitment to learning. Whether it's reading financial statements, studying market trends, or learning from the successes and failures of others, staying informed is crucial for achieving long-term success. Warren Buffett's 7 Rich Rules provide a roadmap for building and sustaining wealth. By following these principles, you can invest wisely, avoid common mistakes, and achieve your financial goals. To build on Warren Buffett's principles and apply them to your investment journey, it's essential to consider how these rules can be tailored to your personal financial situation. Buffett's success isn't just about following a formula, it's about understanding and adapting these rules to create a strategy that works for you. Start by assessing your current financial position. What industries or businesses do you have knowledge of? This is where Buffett's first rule, invest in what you understand, becomes particularly relevant. Take the time to analyze sectors you're familiar with, whether it's technology, healthcare, or consumer goods. Understanding the business model and the competitive landscape will give you an edge when evaluating potential investments. Once you've identified areas of interest, remember to apply Buffett's long-term mindset. Investing is not a sprint, it's a marathon. Choose companies that you believe will continue to grow and thrive over the next decade or more. This doesn't mean you need to hold on to every investment forever, but it does mean that you should enter each investment with the intention of holding it for the long term, unless the fundamentals change. When it comes to selecting specific stocks, focus on quality. Look for companies with strong balance sheets, consistent earnings growth, and a competitive advantage, often referred to as a moat. These companies are better positioned to weather economic downturns and continue generating returns for shareholders. Buffett's preference for buying at a fair price is also critical here. It's easy to get caught up in market hype, but patience is key. Wait for opportunities when the market undervalues a quality company, and then make your move. Buffett's advice on avoiding debt is another pillar that applies to all investors. Leveraging investments can amplify gains, but it also increases risk, particularly in volatile markets. Stick to investing with money you have, and avoid the temptation to take on debt to fund your portfolio. This conservative approach may seem slow, but it's far safer in the long run and aligns with Buffett's disciplined investment strategy. To maintain this discipline, it's important to develop a routine of continuous learning. Buffett's dedication to reading and staying informed is a habit worth emulating. The investment landscape is always changing, with new opportunities and risks emerging all the time. By staying educated, you can adapt to these changes and continue making informed decisions. Lastly, don't forget the importance of patience. One of the most challenging aspects of investing is staying the course when markets are turbulent. But as Buffett has shown, those who remain patient and committed to their strategy are often rewarded. Markets will rise and fall, but quality investments tend to appreciate over time. By incorporating these principles into your investment strategy, you're not just following in Buffett's footsteps, you're building a foundation for your own financial success. Investing is a journey, and with the right mindset, you can achieve your financial goals. To deepen your understanding of Warren Buffett's investment strategies, let's explore how you can implement these rules in various market conditions. The key to successful investing is not just knowing what to do, but understanding how to adapt those principles to different economic environments. In a bull market, where stock prices are generally rising, it can be tempting to jump on the bandwagon and buy into the hype. However, Buffett's strategy advises caution. Even in a rising market, the principles of buying what you know and investing in quality companies at a fair price remain critical. During these times, focus on identifying stocks that might be temporarily undervalued despite the overall upward trend. These are often solid companies that haven't caught the market's full attention yet, providing a good entry point for long-term growth. In contrast, during a bear market, when stock prices are falling, many investors panic and sell their holdings to minimize losses. However, Buffett sees this as an opportunity. In his view, bear markets are when great companies go on sale. This is the time to apply his principle of being fearful when others are greedy, and greedy when others are fearful. By staying calm and focusing on the intrinsic value of companies, you can purchase high-quality stocks at a discount, positioning yourself for significant gains when the market recovers. Another aspect of Buffett's strategy that is often overlooked is his emphasis on continuous improvement. Investing isn't just about making the right decisions once, it's about consistently refining your strategy and learning from your experiences. This approach is particularly important in volatile markets, where conditions can change rapidly. By reviewing your portfolio regularly and staying informed about both macroeconomic trends and specific industries, you can make necessary adjustments to your investments, ensuring that they align with your long-term goals. Diversification is also a topic worth addressing. While Buffett is known for concentrating his investments in a few high-conviction ideas, he also recognizes the importance of not putting all your eggs in one basket. For the average investor, this means balancing your portfolio across different sectors and asset classes to reduce risk. Diversification can help protect your portfolio from significant losses if one area of the market underperforms. However, it's important not to over-diversify, as spreading yourself too thin can dilute your returns and make it harder to keep track of all your investments. Finally, consider the role of cash in your investment strategy. Buffett is a big proponent of having a cash reserve, not just as a safety net but as a strategic tool. Having cash on hand allows you to take advantage of investment opportunities as they arise, especially during market downturns when others may be forced to sell. This flexibility is a crucial part of Buffett's approach, enabling him to capitalize on market inefficiencies. By applying these strategies in different market conditions, you can build a resilient portfolio that is well positioned to achieve long-term success. Whether the market is booming or facing a downturn, sticking to Buffett's principles can help you navigate the ups and downs of investing with confidence. Buffett's philosophy also extends beyond just market conditions, it encompasses a broader understanding of economic cycles and the importance of patience. One of the most critical aspects of his success is his long-term perspective, which allows him to weather short-term volatility and focus on the bigger picture. In an economic downturn, for example, many investors might feel compelled to sell off assets to avoid further losses. However, Buffett sees such periods as a natural part of the economic cycle. Instead of selling, he advises investors to hold onto their well-chosen investments, confident in their ability to recover and grow over time. This patience is not just about waiting out bad times, it's about maintaining faith in the fundamental strength of your investments. Understanding the business cycle is also essential. The economy naturally goes through periods of expansion and contraction, and recognizing where we are in the cycle can help guide your investment decisions. During expansion phases, when consumer confidence is high and businesses are growing, it might be easier to find investment opportunities. However, prices can also be inflated, so it's crucial to remain disciplined in your buying decisions. During contraction phases, the economy slows down, and businesses may struggle. This is when Buffett's advice to buy when there's blood in the streets comes into play. Economic slowdowns can provide opportunities to buy high-quality companies at lower prices, as long as those companies have strong fundamentals and the ability to recover when the economy improves. Another key element of Buffett's strategy is understanding the importance of compounding. By holding onto investments for the long term, you allow the power of compounding to work in your favor. This means reinvesting dividends and letting your earnings generate more earnings over time. Buffett often emphasizes that the best time to sell is never. If you've chosen your investments wisely, they will continue to grow and generate wealth over the years. Moreover, Buffett's approach to risk is instructive. He's famously said that the first rule of investing is not to lose money, and the second rule is to remember the first. This doesn't mean avoiding all risk, but rather, understanding and managing it effectively. It's about making informed decisions, investing in what you understand, and being prepared for the inherent uncertainties of the market. Finally, consider the importance of integrity in investing. Buffett's success is not just a result of his financial acumen, but also his reputation for honesty and fairness. Trustworthiness is an invaluable asset in the business world, and maintaining a strong ethical foundation can lead to better opportunities and relationships in the long run. These lessons from Buffett's approach to investing are timeless and can be applied to any investment strategy. Whether you're just starting or are a seasoned investor, adopting these principles can help you achieve greater success in the market. Buffett's rules for investing extend beyond market strategies. They touch upon the core of financial discipline and personal development. Another critical aspect of his philosophy is the importance of continuous learning and staying informed. Buffett is an avid reader, reportedly spending up to 80% of his day reading and thinking. This habit underscores the value of staying curious and informed about the world around you, the industries you invest in, and the broader economic landscape. The world of investing is dynamic and ever-changing, with new information constantly emerging. By committing to lifelong learning, you can make better informed decisions, adapt to new trends, and avoid common pitfalls that ensnare less knowledgeable investors. Buffett's advice to invest in yourself is particularly relevant here. Whether through formal education, reading, or hands-on experience, building your knowledge base is one of the best investments you can make. Another pillar of Buffett's success is his emphasis on emotional stability. The stock market is often driven by fear and greed, which can lead to irrational decisions. Buffett's calm demeanor and ability to stay level-headed in the face of market volatility have been crucial to his success. He famously said, "Be fearful when others are greedy, and greedy when others are fearful." This contrarian mindset helps him avoid the herd mentality that often leads to poor investment decisions. Maintaining emotional discipline is not easy, especially during market downturns or when investments are underperforming. However, by sticking to a well-thought-out plan and focusing on long-term goals, you can avoid making hasty decisions driven by short-term emotions. Buffett's ability to remain patient and steadfast, even when markets are turbulent, is a key reason for his enduring success. Buffett also places a strong emphasis on the importance of humility and self-awareness in investing. He readily admits when he makes mistakes and is open to learning from them. This humility allows him to avoid overconfidence, which can be a dangerous trap for investors. By acknowledging that you don't know everything and remaining open to new ideas and perspectives, you can improve your decision-making process and avoid costly errors. In addition to humility, Buffett's approach to investing involves a strong sense of discipline. He sticks to his principles and avoids being swayed by market trends or popular opinions. This discipline is evident in his investment strategy, which focuses on long-term value rather than short-term gains. By adhering to a set of well-defined investment criteria, and not deviating from them, you can build a more resilient and successful investment portfolio. Lastly, Buffett's philanthropic efforts highlight the importance of giving back. He has pledged to donate the majority of his wealth to charitable causes, demonstrating that success in investing is not just about accumulating wealth but also about making a positive impact on the world. This mindset of abundance and generosity can be an important motivator, driving you to achieve financial success not only for personal gain, but also to contribute to the greater good. As you apply these principles to your own investing journey, remember that success is a marathon, not a sprint. Stay informed, remain disciplined, and keep learning. These are the keys to building lasting wealth. If you're eager to learn more about investing and personal finance, be sure to subscribe to our channel for more in-depth insights and practical tips. And don't forget to like this video if you found it helpful. Your support helps us continue bringing valuable content to you.